WeWork India's management, Mr. Karan Virwani, the Managing Director and CEO, is joining us right here in the studio as well. Mr. Virwani, thanks so much for joining in today, and many congratulations firstly on the IPO. Let me first start off with why the particular IPO at this particular point of time, because you all have been doing a lot of desk additions over the last few years that has been doing very well. You're very close to being profitable as well. You were in FY25.
Yeah.
Any rationale of choosing the IPO at this particular point of time?
Firstly, thank you so much for having me. I think over the last 8 years, if you see our entire segment, not just WeWork, we've grown what is now known as the flexible workspace segment. It's becoming a larger part of commercial real estate, but still at the very early stages of its entire growth trajectory. It's a sunrise sector, within the real estate space, and in the last 5 years, especially post-COVID, we've seen a lot of adoption from some of the largest companies in the world to some of the best startups, mid-sized companies. And as WeWork India, in that time, we've really grown the business to become now profitable. We're generating, we've grown revenues at a CAGR of 20-25% year over year. And we've reduced debt also. As of January, we did a rights issue into the company, which was actually at a higher value than even the IPO that we're doing right now. That has made the business extremely stable, self-sufficient, in an industry and leadership position in an industry that's growing drastically. And so the IPO seemed like the best thing to do right now from a perspective of being able to create value for investors once they come on board. The ability for us to continuously go on this growth plan and continue to keep our leadership position. And then finally, I think that our business will always require capital because we invest in capex, and this gives us the ability to access the cheapest form of capital, which will come and show itself in your return on equity and finally return on capital itself. So for those reasons, this is why we decided to do it. I think also as Embassy, which is the promoter and the parent business, has invested almost 1,500 crores in this company. WeWork Global has invested close to 700 crores into the company. And this was all at a time where the business was extremely risky. Everyone thought the business model and the business was dead. So now, by being able to do this, as Embassy at least, we can take some of that capital back, strengthen the rest of the group, strengthen the other platforms that we have, and just focus on growing a good business.
That's interesting over here. A quick follow-up, Puneet, I want to take over here is we spoke about the profitability in FY25. First quarter of FY26, the company has incurred a loss to an extent. Want to understand your overall outlook. Will you continue the profitable trajectory, number one? And two, a revenue growth of 17 to 20% is what we've seen in the first quarter. A sustenance of 60% margin profile. Is this combination a possibility?
Yeah. So there's an accounting standard, the India's accounting standard, that impacts our business, in a heavier way because of the way leases are accounted for within India. So you will see that in the EBITDA, which is 63%, like you said, the reported EBITDA, it doesn't take into account the lease costs, right? So the way that we view the business is really, obviously, after all of those expenses, it's a major part of our expenses. So the adjusted EBITDA number is what you really need to look at, which is roughly about 22% or as of last year, 420 crores. Now, in the same light, because of the adjustment of the leases, in the reported numbers, you will see this loss, that the business has. It's not actually a cash loss, but it's the reason is because the leases get treated almost like a liability, and upfront there's a lot of depreciation and interest cost that gets hit on the book. So every time we're expanding and bringing on new centers, the first few years you'll see a heavier hit on the books, which will show this sort of loss. But from a IGAP or even from a cash perspective, that's not the outflow that the business sees or the profit that the business sees. The business actually has been profitable for the last 3 years on an IGAP basis, or really how we look at operating the business, cash in, cash out. That's kind of pretty much what we are looking at. while Q1 has shown you small losses, if you see from the previous quarter, it's down almost 60%, quarter from year over year. And we believe that even through the accounting hit, with the way that the business is growing, the cash flows and the profit margins, we will show profit in the coming quarters continuously,
Okay,
and sustain the revenue growth rate that you're seeing.
Okay, to add to that, let's add the occupancy bit as well, because when you talk about the June 2025 number, your occupancy rates have fallen if I have to compare it to FY23.
Yeah.
I think from 83-84%, it's come down to around 76%. Now, this is somewhere telling you that the desks are vacant somewhere, right? Will this directly then impact your profit margins, or won't it?
Yeah. So FY23, if you see, we had roughly about 60,000 odd seats. Today we're sitting at close to about 114,000. Last year itself, we added about 27,000. Predominant 16,000 of that happened within Q3 and Q4. Yeah. So the way that our business model works, there's a ramp-up period. It typically takes us 4, 6, 8 months to fill up centers. So what you're seeing in Q1 is just a moment in time occupancy because of the expansion that we saw last year. You'll see across most of our portfolio that within 12 months we take the centers up to about 80-85%. We've done that over the last 7 million square foot, and this expansion is of 1 million odd square foot that came in the last 2 quarters. In the next quarter, we're already seeing that occupancies have now come back up, and this will continuously actually keep happening depending on center addition, and new inventory expansion as we keep growing. Just sorry, a pointer note on this is that FY24, we had an average occupancy of about 80%. We delivered 20.4% EBITDA margins. Last year, we had a slightly lower occupancy, 76% on average, but delivered a 22% EBITDA margin. So there's clear margin expansion in the business, even as we're bringing on all of this excess capacity or bringing on fresh capacity today.
You mentioned that at the start of this year you had a rights issue as well to the fund, and while there was a higher valuation compared to the IPO, were the investors okay with this particular valuation that you're going with at this particular point of time? Because we've seen a flurry of IPOs as well, and some in your space as well. So what has been the conversation regarding the valuation at this point of time?
Yeah, look, we went through an extensive book building process, and actually if you see the anchor book itself, today we have some of the top domestic, so iPru to HDFC MF to Moti to Access, all 360, all of these are really large names and a very high quality book. And also foreigns like Goldman, Amundi and ADIC also, who have now joined the cap table. So that is what we wanted, a very high quality book. And if that meant doing it at a slightly lower price than what we did recently, we're completely okay with it, because to us, there's firstly already a lot left on the table, and we think that in the next few months or the next few quarters, this won't matter. For everyone will get to make money, and everyone will see some upside for sure.
Okay.
No, go ahead.
Okay. So with the upside that investors are watching out for, I mean, that's why it's an OFS for 3,000 crores already. You've not considered a fresh issue at all.
Yeah.
So is it that the company has sufficient funds to meet the further capex demand that could be coming in and cater to the debt, or what is the plan on that aspect?
Yeah, it's exactly that. So after the rights issue, which we did in January, we used all of that capital to pay off a huge chunk of debt, which has freed up cash flows. And as you know, as of last year, we're delivering EBITDAs of 420 crores post all expenses. So with the reduced debt and now the cash flows that the business is generating, we actually have more than sufficient capital to keep growing on this 25,000 desk addition that we have in mind, and service the debt that we have also. We also are able to really access quite cheap capital, cheap debt, moving forward as well. Today, our cost of capital will be, in the 10% range. Hopefully, after the IPO, that comes down, even further. And so we will balance internal accruals with some, small amount of debt and just keep managing that as we continue to grow.
When you're adding desk, you're almost at 114,000 as you mentioned, and that has been a steady increase since 2017.
Yeah.
And I see that you're in some key cities, Bengaluru, Mumbai, Pune being the top three.
Yeah.
When you're adding a desk, does it matter of which geography it is in terms of cost, and does it matter in terms of break even of that particular desk? How long does it take, essentially, in terms of geographical expansion?
Yeah, it's a great question. So our presence and our growth is largely try to follow demand in the country, as a whole, commercial leasing demand. 95% of that happens within the top 8 cities itself in India. Bangalore accounts for almost 35 to 40% of all commercial leasing. Mumbai, Gurgaon are some of the larger markets. Hyderabad is becoming a much larger market now as GCCs move there. So our focus is to grow deep within these. Now, in terms of the product, we deliver a pretty standard product regardless of the city and the pricing. There will be some tweaks, like a BKC location will be slightly more premium versus maybe a location in Chennai where the pricing is low, we don't spend as much, but overall the experience is the same. The pricing does have an impact on how quickly the capex gets recovered, right? And today we have buildings that are priced at 12,000 going up all the way to 60,000. So on average today, our return on capex is roughly about 35%, which means within 3 to 4 years at the most, we're recovering all of the initial capital, that's invested in the asset.
Okay. With everything said and done, I think we've just gotten a story wherein an investor has flagged disclosure lapses and there is SEBI inaction is what they've indicated. The hearing continues in the Bombay High Court as we speak right now.
Yeah.
What is it that you would have to say? Because the allegation is on material non-disclosures and regulatory inaction, misleading statements and significant omissions, and it says concealment of a criminal charge sheet against promoters. What would you want to tell investors?
I mean, all I would say is that we've been through the most extensive approval process when it comes to SEBI. We have disclosed not just what we needed to from a regulatory or law perspective, but we've actually gone over and above that to disclose. And this is really like some pressure tactics that we have from, certain business that has an issue, not just actually not with WeWork, with the Embassy REIT, which is where, this issue has come up. And just because we're going IPO, they think that, by doing this at a vulnerable position is going to have some impact on us. It's not. As a company and as WeWork, we are the squeakiest clean type of organization.
So what's your argument to it in the court right now? Because I know, there is an advocate who is representing WeWorks as well. So what is the argument that you have, number one?
There's no argument. We've made all the disclosures that we need to. And, SEBI has gone through its process and given us the approval. And
so if anything negative comes out of this in terms of the hearing, is there a possibility that they could stall the IPO?
No, we don't see anything negative coming out of this. This is just a way to have some bad publicity or like pressurize us, which is not going to happen. And we are in a great place. We're very confident about the business, the growth, and we've done everything that we needed to do.
Absolutely. And this really helps an investor or a viewer when that clarification comes in from the promoter, when stories like this do come up. But thank you, Karan, so much for joining us on the show and giving that clarification to the viewer as well, that everything stands solid, strong. That is what Karan is indicating right now. And I think this is the clarification that all investors would want to hear from the horse's mouth as well.